Coming out of the seismic dislocations of the pandemic, there were some who thought the investing landscape had been fundamentally altered. But our featured guest today says many of those big changes are unwinding and familiar investing themes are taking center stage again. Joining us now to discuss is Jitania Kandhari, Deputy CIO of the Solutions and Multi-Asset Group, Head of Macro and Thematic Research for Emerging Markets Equity, and Portfolio Manager for the Passport Equity Strategies at Morgan Stanley Investment Management. Jitania, it's great to have you back on the program.
Thank you for having me here, Greg.
Let's talk about the environment we're in right now. As we were saying off the top, the pandemic was a massive dislocation, and a lot of things changed. Perhaps people thought that the world had changed for good. You're taking a look at the kind of world we're in now in 2024 and saying, you know what, it's not that unfamiliar from what we're used to. Walk me through that.
Yeah, we're reverting to familiar patterns, right? Whether it's 60-40, which was thrown out of the window, like this is not going to work, it's coming back. The higher for longer is moving towards higher for no longer, in my opinion. All the green transition has not really curbed oil demand so far. So interesting themes and trends that were being spoken about are kind of mean reverting. Even populism from an election standpoint, given a heavy election year, seems to be peaking, and which was becoming like the big rhetoric in the past that global populism is exploding. I think that is also leveling off at the margin. So interesting reversion to mean patterns across some of these themes that were talked about.
So I was breaking some of those down because obviously this is a world that perhaps we can approach and understand because we lived in this world before. Let's start with the 60-40 portfolio, because there were people, that's the whole idea, is like diversification, right? If equities are doing this, then bonds offset it and vice versa. And then you had this environment coming out of the pandemic where no, both were going down at the same time. Well, walk me through that, why we think now 60-40 actually will work again in the future or even work now.
Yeah, so 60-40, interestingly, in 2022 was down 17.5%, the worst return since fourth worst return in the 200-year history, but worst return since 1937. 17.5% down in 2022, 17% up in 2023. So an interesting volatile swing. As you mentioned, the diversification benefit of bonds in that balanced portfolio, or the moderately balanced portfolio, was under question because the correlation between stocks and bonds became positive after 25 years of negative correlation in 2022, given all the macro conditions. But what's really interesting, we've looked at this 200-year data, which shows that what really drives that correlation is inflation. And we looked at several macro indicators, and inflation was the one. And I have a chart here which has divided this entire period into different inflation deciles. And whenever, if you can see, the inflation crosses 2.5%, 2.4 to be precise, that correlation between stock and bonds gets positive, reducing that diversification potential of bonds. Now with inflation coming down, I think that correlation is not going to be as high as we saw in 2022, bringing back that diversification potential for bonds, especially if there is an economic slowdown or a market correction driven by inflation or any of these issues that are gripping the market at this point. More importantly, there is also a mean reversion argument. So if you look at, again, this 200-year data, whenever stocks and bonds have been down in a year, the next 2 years have been positive for this combination. Again, an event study based on this data. So diversification argument and the mean reversion potential. Both these reasons make me believe that this is a good starting point for asset allocation at these levels.
Right, so if we use 60-40 then as our frame based on those ideas, what looks interesting inside a 60-40 portfolio in the world we're living in now?
Yeah, so within equities, of course, US equities, we've talked about the concentration, the Magnificent Seven. I think really looking outside in an equal cap weighted US index is presenting an interesting opportunity. I do like different segments of the US market. Of course, there will be some technology stocks that do well, but industrials in the energy complex, select financials, there are opportunities emerging in the ex Mega 7 space, which are not expensive and look promising even from a thematic perspective. I do like international markets to diversify from that home bias. Pockets of Europe should benefit with the euro where it is, and also small cap Europe looks very interesting given floating rate is a big part of those companies, and if rates come down then they have a nice kicker going forward, and they are very cheap. Emerging markets ex-China, there are several opportunities in India and Latin America, some of the Southeast Asian markets that are benefiting from the China plus one and a new growth cycle. So the 60 needs to be very actively managed given the opportunities in select parts of the world. On the fixed income side, I do think that over 4.5% yield on the 10-year is a very good duration trade, and we can talk about the reasons why. We do like the investment grade as well, because if in the event that there's a slowdown or the recession, then the higher quality fixed income pockets look good. And emerging market debt also looks very interesting because these central banks have been way ahead in the tightening cycle, have been preemptive. So again, taking a diversified view within that 40 fixed income portfolio also makes sense at this stage of the market and economic cycle.
I imagine part of that view, or probably a large part of that view too, is your idea, as you were saying, inflation. We were talking about inflation higher for longer, rates not higher for longer, no longer going to stay high. At some point we're going to get some cuts. That must feed all back into what we're talking about.
Yes, so I think the rate story is going to be nicely volatile given,
nicely volatile, that's an interesting way of putting it.
Giving us opportunities to kind of really positioning for the long term. So the way I'm thinking about rates is really from a historical perspective. Like I've looked at, again, I like to back a lot of our research and data with historical evidence. The 3 times when debt to GDP spiked in the US were during the wars, the 1860 Civil War, the 2 World Wars, and more recently during COVID and post-COVID. You've seen debt spikes. Today, US public debt is 120% of GDP, so it is at an all-time high. And it's interesting that in all these periods when debt spiked, the real rates, as proxied by 10-year minus the CPI, have remained negative. And there is an economic reason for that, because if you have such high debt, to grow out of that debt or to service that debt, you need real rates lower than your GDP so that you can service that debt with lower interest rates relative to your economic output, and you can boost that economic output to support that debt. And I think that this time cannot be different, because we need to be in that same situations, otherwise something will break. So if I assume that inflation settles at 2.5%, 2.5 to 3%, for example, I don't know if it'll really go to the 2% target, but assuming 2.5 to 3%, a 4.5, 5% 10-year is a neutralish, with rates at 2%, with GDP at 2%, is in line with GDP. So I think that's what I think is fair value of where those rates should be. Else, with this high debt, something can break in the system. So keeping that economic template in mind is a good way to position in the fixed income trade. And as I said, there's going to be volatility, because day to day, what's the market pricing in? Is it March? Is it June? Is it how much in March? How much in June? How much beyond? So I think that will create that volatility, but keeping that template in mind, that the 2% real rate with a 2% GDP is the worst. At worst, that should be like the real rate situation. And kind of positioning for that in the portfolios would be a good way to build the fixed income portfolio.